Here we are, 5:52 a.m. Pacific Standard Time. What day is it? It's a 9/23/2011. That's what I said. And not only that, it's a weekly options expiration. The markets have taken tremendous haircuts in the last few days. On the short side of the market's been just paying wonderful. Boy, has it been paying. In fact, it's been paying good enough that within 5-day trend cycles and volatility cycles, you start taking money off on the put side and collecting your revenues. The thing about it is, on this particular witch with the contagion fear, we are going to do one of two things. Plan A is you get a knife hook low in, you reverse, you don't look back. How do you verify it? Because your 3-minute bars are like 3 to 5 teenies long. And then the pullbacks just don't seem to come. And the broader indexes have broad-based buying across the board. And why would that be? It would be that the short interest that's currently within the 5-day cycle would be bought back, and or with a reversal to the upside, then the bear shorts have to buy to cover, which would give the MMT market maker a shot up to the next deltas before they roll over again. And yesterday they did exactly that. Yesterday we made great markets once again. And yes, they're very exciting because you're making a market between all of their public emotion, and we went over all of those things and how the public operates. Don't they love it? Look at them. They don't even know what to think. They don't know how to handle price volatility. They don't know how to handle a weekly options expiration or a monthly triple or a triple witch or a monthly. I don't. And then the volatility takes them out because they can't deal with that either. They think they can, but if they really look at themselves in the mirror, they get their answers right there. That's where they can get their answers. Left elbow gap down. Another one because of Europe. You got Google, Priceline, ISRG. You've got everything so far. This week you've had a lot of September trade involved. And what is that? Asset allocation models in play. Asset allocation models in play. What does that mean? Well, I sell my winners. And then, in September, I go looking for value. Left elbow gap down is that immediate reversal. The other scenario is in the last hour that the indexes are screaming at their highs and you've got broad-based buying across every sector. You will know that this particular 52-week low that's going to gap down toward that 1101 on the S&P, and if it doesn't hold, it's going to break down in below that channel, create another secondary low in indexes should we break that, and then that lower end in the S&P around 1085 would bounce in upside volatility, but maybe only to 1150. And 1150 back down to 1020, and we got the October earnings, and there's lots of stuff. But if what you would want to confirm is in the last hour, stocks all end up in positive territory, going long, and a very catastrophic financials around the world are experiencing right now. But they can do that. So we're going to take a look at the trade management just like yesterday. We rolled up off of that bottom, bam, and then that short came right in, and then that ratio went right down, and for a lot of the day, because of the amount of selling, we were down over 500 handles on the Dow. Oh yeah. And then we had a gap up going last night, but then Europe sold off so high that it took our futures down and our prices down. Watch the bull, watch the Amazons, watch the Apples, and watch how they hit at that first support level, and then that 369 breakout with the half bar test. Maybe the half bar test doesn't come back. Maybe it's one of these breakouts that have to go a whole lot further, and then they pull back slightly and diminish. We'll see. The seller will have to be out of the market in order for this to occur. So let's have the reality of why it could happen. There wouldn't be any more sellers. And that the short interest that's piled on the market right now has to buy to cover, and that also acts as a support level for the markets. And that's where the reversals come in. So between the bull and the bear, this is how bulls and bears are always knocking heads with each other. And this is how we can establish that using our platform. We will be able to tell immediately if that's in play. And that's one of our trade management scenarios. Off of the videotape, I'm going to start giving out all the calls. Again, we are market makers in the option pit. And people say, oh boy, I don't know anything about them. I never want to trade them. But as soon as they start learning a little bit how, then that's all they ever want. Because you can make good markets with good leadership equities, like the Apples, like the Googles, like the leaders of Amazon. But they better be a leader, and they better be the best of the breed. When you're going to make market in options, you don't want to make a market in options with some old crappy stock. It's got to be the best stock. It's got to be the best leader. It's got to have the best price action. Weekly, compounded price action. We're going to trade it. And we're going to trade it in these trading management scenarios, and they'll be verified. Once that seller is out of the way, this gap down today is, we're looking for it because it's part of one of our trade management scenarios. Whether it comes or not, who cares? We'll know. And then that's where we're going to get net long. But we're going to take a look that every time it comes up to the higher delta, if they start to roll right back over like yesterday and go back down and break the previous lows from it, you'll have to transact that short. And we had a lot of MMTs just kicking rear end yesterday. They were getting, Leo got 1,000 pennies out of Amazon, long and short, 400 and some pennies down, 600 pennies up. Pennies every which way. We had people like Fritz making a market on Sina and getting that left elbow down there and got it, and it took it up for what it was worth. But made markets both long and short, because that equals 2. That equals more trade management, SMF, MMT, market maker, debit, positive debit management. That's the gap open down. On the other side, there could be a straggler. It's not as bad yesterday. Here, on the gap open, something's wrong here. So gap open up. You have 2 stocks that qualify. Both of what we don't really cover. AMAC and REGN. That's your gap up ratio to your gap down. Now in pre-market yesterday, everything was gapping down. That this list was long, super long yesterday. Today it's not as long. But you know what qualifies? 1.00 or higher. It's not as long. And I'll just throw in here very quickly the NYSE. Yesterday, you people that are new MMTs never have ever seen how that every one of these, every single stock on the NYSE had a gap down ratio of 1.00 or higher. The whole NYSE met it. You don't see that today. So yesterday was the 22nd. You don't see this here on the 23rd like you seen yesterday. Every single stock had a negative ratio gap of 1.00 or higher, and it was every single stock on the gap open down on the NYSE. True story. Go to SMF and go look at pre-market analysis. We are leveraging up on the Apple trade, and we are leveraging up here. So that means that the 515 call over here, we're going to work on that next. That's the gap open down on the NYSE. I'm concluding the tape. The thing about it is, it's a weekly options expiration, and we will go for the lower bids. I'll be giving them out. If they run them, they're going to run them. And they run them back up to yesterday's close. If they start to fail right then and there, then you start selling your calls and buying the put option on the opposite side of that.